So what really happens when you deposit money in a bank? I mean, it seems like the simplest question in the world, right? You give them your cash, they stick it in a vault, and maybe they lend some of it out. But what if I told you that simple story isn't just a little bit wrong? What if it's completely 100% backwards?
In this explainer, we're going to pull back the curtain on what's called the money illusion. We're going to see what's really going on with our money, with our banks, and, believe it or not, with our own brains every single time we spend.
Here's the plan. We'll start by totally busting the great banking myth we were all taught as kids. Then, we'll get into the wild story of how money is actually created. After that, we'll look at a pretty surprising consequence of that system and then dive into the psychology that drives how we spend. And finally, we'll tie it all together and see what it really means for you.
All right, first up, let's talk about the story we all know and love. The simple, intuitive piggy bank model of how a bank is supposed to work.
You know the drill. You work hard, you save some money, you deposit it in the bank. The bank then acts like this trusted middleman, holding on to your cash and lending that exact money to someone else who wants to buy a car or a house. In this story, your deposits create loans. It makes perfect sense. The only problem? It's a fairy tale. That is not how it works.
So if that's the myth, let's get to our reality check and see how money is actually born in our modern economy. And hey, prepare to have your mind bent just a little bit.
Here it is, the absolute key to understanding everything. While the myth says that deposits create loans, the reality is the complete opposite. Loans create deposits. When a bank gives someone a loan, it doesn't go look in its vault for someone else's savings. It creates brand new money out of thin air, right there on the spot.
And look, this isn't some fringe idea. The famous economist Joseph Schumpeter said it plainly. Banks don't lend out money that's been trusted to them. They create deposits in their act of lending. So how on earth does this work? Well, it's basically just an accounting trick. When the bank approves your mortgage, that loan becomes an asset on their books. At the exact same second, they create a brand new deposit in your account for that same amount, which is a liability for them. And poof, just like that, new money exists that didn't exist before. The real thing stopping banks from doing this infinitely isn't how many deposits they have, but whether the loan is profitable and whether they meet their regulatory capital requirements.
Now, a system where private banks can create money has some profound consequences. And one of the biggest ones to emerge in recent years is how we handle failing banks, which led to something called a bail-in.
You remember the 2008 financial crisis, right? There was this massive public anger over taxpayer-funded bailouts for banks that were considered too big to fail. So in response, policymakers all around the world, from the US to the G20, came up with a brand new framework, the bail-in.
So a bail-in lets a bank on the brink of collapse use its creditors' money to save itself. And here is the absolute kicker. Legally speaking, when you deposit money in a bank, you're not just storing it. You're making an unsecured loan to that bank. That means you're in line with other creditors the bank owes money to, and there's no collateral backing up what they owe you. Now, the sources we reviewed for this explainer point out a major concern here. The argument goes that instead of actually solving the whole too-big-to-fail problem, bail-ins just shift who pays for the rescue. Instead of the taxpayer, it's now the bank's own unsecured creditors, which, as we just learned, includes you, the depositor.
Okay, we have been way up at the 30,000-foot view of global finance. Let's bring this all the way down to earth. In fact, let's go right inside our own heads and see how the very nature of this modern abstract money actually messes with how we spend it. We love to think of ourselves as rational creatures, right? Especially with money. But our brains have other plans. A model like the triune brain shows us that our emotional, instinct-driven brain often hijacks our logical brain. And when it comes to opening our wallets, that means our feelings very often win out over financial common sense. This all leads to a fascinating concept called the pain of pain. It's that little psychological sting, that ouch you feel when you have to part with your money. And here's the crucial part. That pain is way, way stronger when you physically hand over cash versus when you just tap a plastic card or click buy now.
And this effect isn't small. I mean, check this out. It's a classic study. They asked students how much they'd pay for Celtics tickets. The ones paying with cash, they were willing to spend about $28. But the ones who could use a credit card, that number shot up to over $60. That is more than double the price for the exact same thing. The pain of using cash literally made the tickets feel less valuable. And you see this play out in everyday life, like at the grocery store. Because swiping a card doesn't hurt, our impulse control just kind of goes out the window. Studies show we're way more likely to grab stuff we didn't plan on buying, especially junk food, the temptations. When the money feels less real, the consequences feel less real too. So, wow, we've gone from how the global financial system works all the way down to our brain's chemistry when we buy a bag of chips. Let's pull all of these threads together and see what the big picture really looks like.
So, let's just connect these dots. We've learned that the money in your bank account wasn't put there by a saver. It was created out of thin air when the bank made a loan. We've learned that this very system creates risks that are now backed up by your money, because your deposit is legally a loan to the bank. And finally, we've seen how the digital, abstract nature of that money actually hacks our brains and makes us spend more of it.
So just think about that for a second. The digital money in your account was created by a bank. You are now legally loaning it back to them, and its very form is designed in a way that makes you spend it more freely. The entire system, from top to bottom, is kind of built on an illusion. And now that you see behind the curtain, does that change how you see your wallet?